Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. This is the seventh of the podcasts focusing exclusively on the markets, and this series is coming to you regularly every month. Bringing insights from experts on the subject is your host, Parvatha Vardhini. I am the editor of BL Portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this month is Mr. Siddharth Vora, Head Investment Strategy and Fund Manager, Prabhudas Lilladher PMS. Siddharth is also an Executive Director with Prabhudas Lilladher. Siddharth is a CA and a CFA and has been with the group since 2016. He specializes in applying quantitative techniques to investment decisions. Hi, Siddharth. Welcome to the podcast.
Hey, hi.
How are you doing?
Very good. What about you?
All well here. So, an
I
interesting
think
time
the
for
markets are spoiling the moods a little bit. I
That's what I
think
was.
it was
Yeah.
long overdue. It was long overdue, given the steeper valuations in the mid and small cap buckets of the market, and maybe some healthy profit booking after a very long rally. So I think
Okay.
it's a good phase for people to rebuild their portfolios, rejig their portfolios.
Okay. Got it. So, I was going to say, yeah, very interesting times because I did have this question for you. Maybe we could start right away. So, do you see the upcycle which started after the COVID low in 2020 slowly consolidating and coming to an end? Do you see 2024 to be more of a year of consolidation?
I don't see it as a year of consolidation. What I do see it is, I think the next couple of weeks or maybe just a couple of months could be consolidative in terms of, shift from mid and small caps to larger caps, and more from the breadth of the market could sort of reduce at this point, given that the bulk of the last 2.5 years have been a mid and small cap rally. And I think now the valuation froth is starting to become very evident, not only to the institutions, but also to the retailers. Even the retail investors are now, concerned that, market valuations are very steep, and the strong flows in the funds, right? Mid cap funds, small cap funds, etc. I think all of that can sober down a bit. And with that, of course, as flows start sobering down, markets could consolidate for some time, but I don't think there's anything really structurally stopping the Indian economy or the Indian markets.
Oh, okay. So that way, see, in the beginning of the year, when, the equity market, if I should call it as predictions, came out, a mid to high teens earnings growth was expected for 2024. So, nifty earnings growth. So, in your view, do you expect that then to stay put, or would it moderate a little bit?
I think this year we have delivered on that mid to high teens earnings growth on a YOY basis. I'm talking more about the broad Nifty 500, like the top 500 companies of India.
Okay.
I think whether we look at the sales numbers or the net earnings or the EBITDA, I think we've been healthy in the 20 to 25% sort of growth on a YOY basis. But the moment we narrow down the focus on Nifty, I think we can expect some moderation in the 12 to 15% in the year to come, because we are already coming from a very strong year of performance. So the base is now higher. We do believe that some moderation in earnings and hence some moderation in returns would be a healthier outcome for investors.
Okay. Got it. And are you already seeing it in the December quarter earnings, or you're saying the coming quarters would probably show it more, the moderation?
I think the coming quarter, the December quarter has been fairly robust, leaving a few pockets where we've seen some mixed results in the agrochemical and chemical space. I think there are some areas of the market and some sectors which have really done stupendous growth, to be honest. And I think while the larger caps of India are growing at a slower clip, the mid and small caps are growing at a much higher clip.
Right.
So I believe some sort of rotation as the markets see that, mid and small caps are factoring in bulk of the growth in their valuations. Rotation to large caps where the growth is lower, but the valuations are also more comfortable and rewarding. I think that's the sort of move I do expect in the coming quarters.
Okay, okay. You specialize in quantitative techniques. So we've heard a lot of fundamental views or even technical views on where the market would, be, where the market would head from here on. What more does a quantitative technique add, which is not there in fundamental and technical analysis? Like this will be essentially be the foundation of your investment framework, isn't it?
Absolutely, absolutely. So again, we run two different types of strategies. One is a multi-asset strategy and one is an equity strategy.
Okay.
And the indicators or the quantitative frameworks used for both are significantly different from each other. To give you some examples, so when we want to select stocks, we want to use a multi-dimensional framework, which looks at sector analysis, style analysis, fundamental analysis of individual securities, technical analysis of individual securities, risk analytics, liquidity analytics, valuation analytics, and volatility analytics. All of this combined gives us a very holistic view on each security. And therefore, we are able to pick stocks that help us generate alpha and manage risk. Now, let me make it clear that when we are talking about evaluating stocks on, say, fundamental or technical or valuation basis, we don't do this subjectively. We don't read the balance sheet or look at charts. Everything is pre-programmed as indicators, as parameters, as factors. So the whole thing is very mathematical. It is extremely objective with no room for subjectivity. Eventually, every stock or every security is allocated a score on all these different parameters that I briefly mentioned about. And the stocks with the highest scores actually make it into our portfolio. And this is done dynamically on a periodic basis. Now, when I talk about a multi-asset setup, over there, the focus is less on securities and more on asset allocation itself. But the factors that drive asset allocation are fairly different. For example, we look at global macros, global liquidity, monetary conditions, risk appetite, sentiment, trend analytics, and valuation analytics amongst the different asset classes. Okay. The idea is to take a very, very top-down view of the markets, of the macros, and of the different asset classes. If we are in a risk-on phase based on our indicators, we want to be tilted heavily towards equities. Within equities, also maybe more weights towards mid and small and less towards large. As we move from a risk on to a risk transition phase, which we believe we are in now, we gradually start trimming our equity allocations, increasing our large cap allocations, reduce our portfolio beta. And the moment we go towards a risk off phase, that's when we want to increase our allocation to fixed income, to precious metals, and moderate our allocations to equities to reduce the overall risk for investors. Based on these three key regimes, right? Risk on, risk transition, and risk off, we change the asset allocation in our portfolios.
Okay. So what, I understood that you have a score and then you pick up stocks based on the score. So what is the trigger for risk on, risk transition and risk off phases? You did say that we are in a risk transition phase. So what is the trigger?
Okay, so I'll just again give you a few examples which are beyond, say, fundamental and technical analysis, which are part of our quantitative models and quantitative indicators. So the first thing we look at is global market breadth. So what we're trying to see here is, as an asset class, how favored is equity globally? Because systemic risk, which stems from preference towards or preference against equities as an asset class, is a key source of returns or risk in equities. So we look at 56 different global equity indices and we try to evaluate how many of these indices are trading above their 50-day moving average. That's one indicator. When we talk about more market microstructure analytics, we're trying to see, say, in India, how many stocks in the mid, small, and large cap buckets are still trading closer to highs or trading closer to lows.
Mm.
If more stocks are trading closer to lows or starting to make new lows, we need to see that, okay, there is some weakness that is building up in the market. The other thing we look at is how many securities are trading 2 standard deviation above their long-term valuation averages. That gives us a gauge on how heated the market is.
Okay.
So, for example, in the small cap space, 70% of the securities are trading more than 2 standard deviation above their long-term valuation averages. In the mid-cap space is 65, and in the large cap space, it is close to 60. So we can see that, okay, the valuation risk is higher in the smaller caps and lower in the larger caps.
Mm.
Similarly, we also look at market breadth. What market breadth tells us is how many stocks are possibly declining on a monthly basis in the 3 different buckets of the market. How many stocks are probably trading below their 200-day moving average? How many stocks have started to make new lows? We look at all these indicators from a breadth point of view to gauge the overall market sentiment. And that tells us that is there strength in the markets? Is there weakness in the market, or is the strength reducing in the market? So right now we are in a phase where we don't see weakness, but we definitely see the strength reducing.
Okay. And so depending on, the triggers that you just described, so how your percentage allocations will change to different asset classes? I mean, what is the range in which it would change? Can you give us a idea?
Again, I'll give you live examples from my fund, right?
Mm.
So the Aqua portfolio, which is our equity strategy, it's a flexi cap equity strategy, which means it can dynamically invest across large, mid, and small while changing its exposures to large, mid, and small. So till January, 70 to 75% of the portfolio was mid and small cap oriented. But the moment we moved into February, 50% of the portfolio is now large cap oriented, 27% is mid cap, and only 23% is small cap. So we've gradually started increasing our large cap exposure, reducing our mid and small exposure. This is in line with the market cycle.
Okay.
We need a strategy that can adapt to the changing market.
Okay. So even in your multi-asset strategy between debt and equity, so
Right.
you would do this kind of a switching. I mean, your gold or your other the third asset class will be a much smaller percentage, and predominantly it would be between debt and equity. Is that how it works?
Not really. So I'll tell you, in my multi-asset scheme, we in October, for example, October 2022, we increased our gold allocation to 25%, which did really well for us. And for bulk of 22, our equity allocation was less than 50%. As we moved into 2023, our equity allocation started going closer to the 90% mark.
Okay.
But our debt was at 6 and gold was at 4. As we speak today, still our equity allocation is close to the 80% mark. Gold is still at the 4% mark, and debt is at 14% mark. So we've not transitioned into risk off yet, while we do see some moderation in risk.
Understood. Okay. Based on these quant methods, would you also be able to identify sectors that are overheated or sectors where you need to add or prune holdings?
Absolutely. That is actually a big part of our quantitative strategy. So let me just briefly tell you what my investment framework is and how sector rotation is the first pillar of my investment framework and how we really approach sector rotation. I think that'll give you a very holistic picture. So the investment framework that we follow is called the 6S framework for the equity strategy. So the 6 S's include sector rotation, style alignment, superior fundamentals, sound valuations, strong technicals, and smart risk management. These are the 6 S's we use in the equity strategy. Now, what sector rotation, which is your question, does is we evaluate the different sectors in the market. We've created proprietary, 100 odd thematic baskets in the Indian markets, and we evaluate each of them based on growth, valuation, sentiment, breadth, trend, and volatility. And based on this evaluation, we give a rank to all the different sectors in the markets. What that helps us do is position us in the right sectors at the right time. Because our research suggests that even a decent stock in the best sector or in the right sector will yield much superior outcomes as opposed to the best stock in the wrong sector. So sector selection, elimination, allocation, and rotation will drive 72% of your investment returns. And hence, it is a key pillar of our investment strategy. And
Okay,
we are
so what is the model actually indicating, Siddharth? What are the sectors that the model is asking you to stay out of, and what are the sectors that are in?
sure. So over the last 8 months, we have completely stayed out of private banks. We have completely stayed out of chemicals, agrochemicals. We have also stayed out of IT almost till December. Now, gradually, we've had some exposure to IT services as well. Mainly, we were focused on diversified financials in the nature of NBFCs, asset management companies, capital market plays, brokers, exchanges, PSU banks, and NBFCs. These were bulk of our allocation. Say close to 35% of the portfolio was in financials, but not in the traditional HDFC Bank, Kotak Bank, ICICI Bank, Axis Bank type stocks. We were almost 40% of the portfolio was focused towards the theme of industrials and manufacturing, which covers everything from defense, ports, shipping, infrastructure, capital goods, engineering. So this was a very big theme that we identified and got it right in the portfolio. Now, if I talk about my current allocations, energy is a big theme right now. Close to 20% of the portfolio is in the energy and utilities theme. 17% is financials. Another 17% is automobiles. So these are, and 13% is utilities. So these are some of the themes we are now looking at.
Okay.
We've gradually built a 10%, 12% odd allocation even towards healthcare over the last, say, 2 odd months in the portfolio.
Okay.
So again, when you look at it, the first 6 months were pro-cyclical sectors, industrials, automobiles, etc. Now we are adding an element of some defensive sectors like utilities, healthcare, etc. also in the portfolio.
Understood. So Siddharth, essentially, now, you offer a PMS strategy where can I call it fund manager skills or intuition is not so much, or research may not so much be needed? And where does this kind of a strategy find its place in an investor's portfolio?
Perfect. So fund managers' skills are tested in designing, developing, programming the strategy and the layers of the strategy. I think we've spent, like me and my team of 20 quants have spent close to 4 years in developing this strategy. So all the heavy lifting is done there. Now we continuously review, refine, and try to find ways of improving the models. But we don't tamper with the output of the model. Follow the output as is. If we have a problem with the output, we go back and try to refine and review the processes, but not the final outcome. So yes, fund manager biases are the biggest reason why we have chosen to take the quantitative approach to investing. Let me just throw some light on some numbers. You'll have a clearer picture of that. So 91% of the quant schemes in India have outperformed the benchmark over a 5-year period, whereas only 35 odd percent of actively managed strategies in India have outperformed benchmark over a 5-year period.
Okay.
And in USA, 35% of all the money is managed quantitatively, while in India, it's closer to the 1.5% mark. And the biggest figure to understand here is 30 years back, the figure in US was 89% of the money was managed actively, as opposed to today, where only around 20-25% is managed actively. So active money management is losing market share to passive and quant. So I believe in India also, because of key man risk, fund manager bias, like behavioral, emotional, and style biases, we will see a big transition to more systematically run strategies, which are more sophisticated in terms of managing risk and adapting the portfolio to the changing market cycle.
How do you sell stocks? How do you decide when to sell, how much to sell? Do your methods also tell you that? So how do you manage risk essentially?
Perfect. So I think this is a very important question, relevant for most investors. So what we do in our strategy is we take risk, we deal with risks in two ways. First is dealing with known risks, and the second is dealing with unknown risks. We deal with known risks by using liquidity filters, fundamental filters, a benchmark agnostic allocation weight. We use an equal weighted strategy so that the profit is not concentrated in one or two stocks. At the same time, the portfolio is optimally diversified across 25 to 30 stocks. But what we do very interesting here is we ensure that the opportunity and timing risk is what we manage using a periodic rebalance mechanism. And this is where dealing with the unknown risks comes in. So what we do is there are 6 key sources of risk, starting from systemic risk, which we deal with asset allocation. We create up to 50% cash when our market and macro risk models tells us to move out of equities and move into a defensive asset like cash or liquids. The other is the size risk. Again, we are dynamic in terms of moving from mid caps, small caps, and shifting allocation to large cap like we did now. The other is sector risk. Based on the periodic rebalance that we do, the sector dimension of the portfolio is also rejigged every 2 months. Not compulsorily all of it, but most of it. And the last one is style and beta risk. What this really entails is if the regime is shifting from value to growth or say quality to momentum, our portfolio changes its color and completely takes on a new color. And finally, all the market volatility can be dealt with only in terms of managing portfolio beta. So in a high beta regime, we use high beta tilt to the portfolio. And in a low beta regime, we use a low beta tilt to the portfolio. And because we rebalance every 2 months, automatically the laggards or the weaker stocks from the portfolio are eliminated and replaced with stronger stocks. And this can happen in 2 situations. First, the stocks that we are holding go down or drop on an absolute basis in terms of their score. And the second, other stocks in the market rise significantly in terms of the relative score. So either my stock is going down on absolute basis or somebody else is doing better and providing a better opportunity on a relative basis. In either cases, my portfolio will be rebalanced to eliminate weak stocks and account for new stocks. And the beauty is we do this without any emotions or without any bias.
Understood. Makes it much more easier to take those decisions, actually. Yeah.
Yes.
And Siddharth, so, among your various parameters, does valuation also figure out? See, there are certain sectors where you find stocks which are constantly at high valuations. And, in a market like, what it has been in the last 3 years, these stocks constantly keep moving up. So you're wondering whether, valuation is at all a parameter. So, how do you approach high valuation stocks when using quantitative techniques?
Sure. I think the answer to deal with high valuations stems from our inherent investment philosophy. So the name aqua, it's inspired by water, which can take any shape, size, color, form, right? Aqua can take any shape, size, color, form. So what aqua really represents in the quant world is an adaptive, quantitative, unbiased, and alpha-focused investment strategy. So what this philosophy teaches us to deal with, high valuation periods, bear market periods is that first you be very, very adaptive, whether it's your asset class, your size, your style, your themes, your factors, your beta. Be adaptive. Don't use a single factor approach to investing. Use a multi-factor or a multi-dimensional approach to investing. The unbiased element of the philosophy teaches us that don't look at valuations in isolation, neither look at valuations on an absolute basis. Everything in the market is relative, which means stocks or markets are cheap or expensive based on their valuation versus their past, versus their peers, and versus the broader indices. Which means a Titan at a very high PE can still not be an expensive stock, but say a PSU stock at a mid to low PE also can be expensive, because valuations are looked at a lens of relativity rather than looking at it from an absolute lens.
Okay.
That is how we deal with high value stocks, because we don't consider them high based on an absolute number. If overall the markets are expensive, overall the sector is expensive, and this stock is falling in the lower quartiles of that sector or the market, then we could still account for it as a cheap stock.
That was an interesting conversation, Siddharth. Yeah, very detailed answers and convincing answers too as to why investors must take quant investing more seriously, and and the fact that quant has to become mainstream was very well put by you. Thank you very much for your time, Siddharth. I'm sure the listeners will benefit a lot from this conversation.
Thank you so much. It was a pleasure.